Hello, this is Dave, and welcome to Equities Story. I'm here with the amazing, wonderful Wolf. And Wolfie, it's so good to see green. I forgot what the color green looked like.
There you go. It looks very, very nice, actually.
Oh, it's lovely.
Very calming.
Yeah, rather than that red that gets you all angry and irritable. Anyway, good to see lots of green.
Where's the disclaimer, by the way?
This is just general share advice and not personal advice. And the disclaimer is somewhere on this computer, Wolf, and I just don't know where, but we are calling out the disclaimer now.
All right. Pretend it's on the screen saying this is all we talk about is the stocks, which means fundamentals and technicals only.
This is just general share advice. And there's no personal advice except Wolf will if you've got problems with, emotional issues, and he helps, you help a lot of people.
I've got many hats I have to wear, Dave. I have to help you sometimes when you cry in a corner. It's part of the job.
Mate, I've been crying a lot recently with this market. But so Wolf, the market bounced last night.
Yep.
We're having a laugh because we've had a look at this. I just said to you, well, hold on a second, America's in recession.
The numbers.
Yeah, we looked at them. The White House has, for the first time in 100 years, they're sort of changing the definition of recession. They're calling it a general slowdown. So, but we are. The America is officially in recession.
Yeah, look, we just need to see another, I suppose, quarter to see exactly where they are with the negatives. But I'd say, look, officially, not officially, they are down there probably.
Yeah, but according to obviously Biden, we're not in recession. It's just a general slowdown because we don't want to panic you.
China number two, right? There's never a negative growth.
No, mate. I think there's more honesty in China now than anywhere else, to be honest. But well, so the American market had a lovely bounce because the Fed came out and they said, hold on a second, we might be tempering these interest rate rises.
Yeah,
which is a very bold statement because they've got no idea. They've got no idea inflation. They've got no idea how it's going to go. But anyway, they gave a prediction. The markets brought it last night. They cheered it. They got all excited, and long may the bounce continue.
Yeah, absolutely. So, I think. Look, they put their necks on the line, no doubts. We've seen it with RBA. They got it wrong.
Well, Wolf, they put their necks. The Fed put their necks on the line last year. Where do you remember the story like inflation was just temporary inflation?
Transitionary is probably
transitionary.
The right.
Yeah, and you fell for that.
Yeah, I did.
Yeah, you did, and I told you that's rubbish, and you didn't listen to me then. And you're not listening to me now. But anyway.
That's because 95% of you talk is rubbish. When you say to grab onto something that's actually true.
But the 5%, which is right, Wolf, right, is very, very important. Okay. So
look, I'm gonna be like a US, Dave. It's transitionary, and transitionary means 5 years.
Yeah. So anyway, the Fed, because we know the economy's in a right mess. They're doing everything they can to make it sound really better than it is.
Yeah, of course.
Which is fair enough.
Like the CEO of the world, right? So they have to obviously paint a positive picture.
Yeah, I thought the IMF was but I thought it was a little bit more honest when they came out yesterday and said things are going to get tough. So we've had a little bit of a bounce, and this is part of the bounce we're talking about. And really, when you look at the charts here, I think we're right, Wolf. 2 more weeks. It takes us into near the end of August. If it follows our exhaustion patterns, we hit the trend line and bang, down we go. So I'd be very, very careful. What I'm saying, Wolf, with this bounce, I'll be using it to take profits. I wouldn't be getting excited and holding on for a bigger ride, right?
No, look, I think like we've been playing these tech stocks, right?
Tight stop
yeah,
losses.
Absolutely. Like we've been playing the tech stocks. It's not forever. We're trying to make some profits here to ease some of our pains that we've had over the last 6 months, right? So if you see a profit, if your company came up with a good result, take it and start again if the chart still looks decent and put a tight stop loss. So that's the play we'll play. There's only a very few contrarian that we're going to hold on for the next, say, 12 months.
Right, Wolf, there's a number of stories today. Can we go through them one by one?
Yep. We can. And just to finish off on with the actual bounce. Obviously, the markets out there were cheering the fact that, like you said, the Fed is becoming less hawkish, which means that the market's forward-looking, thinking that it's going to be better forward on, right? So maybe the peak of inflation. This is what the market's probably trying to figure out. Are we past the peak inflation? Are we past the peak of that strong interest rate rises? And will it get better from now on? I mean, that's the question we're going to have to find out whether it gets answered over the next 3 months. I don't know.
My issue, Wolf, the inflation, I think, is just starting because a lot of companies who believed it was transitory. What's that word again?
Transitionary,
right? What they did, they didn't lift their prices up because you know what they thought? They thought, hang on, I'm not going to lift my prices up right now because it's going to take too much of my market share away. But now they realize that inflation's here to stay. They've got no choice. And that's what I think we're seeing more the second half of this year. All the companies absolutely saying, no, listen, I can't live with this margin squeeze anymore. I'm going to have to lift my prices. And that is what I think we're going to see flying over from China into Australia, unfortunately, over the next 6 months. I think it's going to get worse, not better.
Dave, I agree to a certain extent what you just said, right? But I think it still has to be a fairly balanced approach by the companies that raise prices. They don't want to raise prices too far with consumers maybe not interested anymore, right? So I think there has to be a fine balance between what you can do. And I know the bigger companies, the monopolies, can probably do whatever they want, right? It's the smaller companies that probably have to be wary of going too hard. So we might see a lot more of shrink inflation. Yeah. Well, let's find out how
those packets of crisps, which are getting less and less crisps in them.
Exactly.
Eventually, there'll be just one crisp in them in the future. It'll just be one crisp.
Yeah.
It'll still be the same price. So
that's right. Exactly. And you should be happy with that because it means you're not going to get too fat.
Perfect. Well, that's one thing. If we're all hungry, we're all going to lose a bit of weight.
All right, so let's go through some of these stories, huh?
88.
Yes. Let's start with that one. So I'm going to read through some of these things out. So if you bear with me, I'm going to put them up so we can go through the actual numbers. Let me go a little bit more depth, right? Than we just trying to remember stuff because there was a lot of stuff that came out today. So let's go through and just see where it sits. And now, just to start off with, 88, it's come up with a pretty good result. So today, I think unaudited revenue was 33.4 million, which is 46 million Australian, which is a 33% growth. Excellent in a very tough market, I have to say, with disruptions out there that we thought might affect them much more than it has. So well done to them. I was probably a little bit too bearish on them. Saying that, market cap, what is it? What's the market cap? 700 million, is that right? Which means they are way over 10 times revenues, which I think for this market is just too expensive. So that's the only thing that's really holding me back in going for this. I want to see a pullback before I probably look at this. EBITDA was a positive as well, 3.8 to 4.3 million compared to the previous of 3 million. So that's all positive there. Probably I'd say tier 2 up there on the top of tier 2, but just too expensive.
You know what? I think that the share price is agreeing with you. The price action really this week, Wolf. Good announcement. Mm-hmm. Got an exhaustion pattern. Looks sideways. If you're a trader, you're taking profits. If you believe in the story, you hold it till it breaks trend lines. But you've got to be nervous of it. It's expensive. Anything in this market that's expensive can have a little bit of a headache, can't it?
That's right. That's why I'm not jumping at it. I'd rather, yes, I like the story, but I'd rather buy it on a bit of a weakness, not chasing it up.
Mineral resources, Wolf. Iron ore, lithium, and below water.
Yeah, well, let me tell you why. And it's just fascinating reading some of these things because it just tells you the full picture of what's going on, right? And to me, MIN, there's only probably one thing that you got to look at this, and that is the actual margins and what they're actually getting for the iron ore. So average realized iron ore price for the quarter was $86, right? And the iron ore is at what, 110. So they're getting a huge discount for the iron ore because it's just lesser quality than everything else out there. So for me, not being a super cheap iron ore player like your Rio, BHP, or F&G, the margin's not as good. So it's not a top tier stock. That's why for me, it's always going to be just a trade, right? And I know, they can probably increase the production and so on. That's probably what's going to drive it. But there's going to be a huge element of risk for me. So for example, I'd say if your iron ore drops below $100, you probably want to be out of this.
Right. And the charts, it just needs to do more anyway on the chart, Wolf. It doesn't look too good.
Yep.
Macquarie, where, again, it's always been a bit of a long-term play.
Yep.
We talked about nibbling away here, 154. I think it was sell Natalie at 120. Yep. Sell Natalie hasn't happened yet, but it's holding on very, very well, Wolf. And if you bought this down here at 150, 160 recently, I think you'd be pretty happy.
Oh, look, I think Natalie would be really rejoicing and dancing around, seeing that update quarterly, thinking, I live to live another day. I think on that.
I've actually heard the opposite. I've heard Natalie's really upset that she hasn't been sold. But okay, if you. She's
depends which perspective you look at, right? Anyway, I think she's safe for now. And the quarterly was good enough to see the markets be happy with what they are seeing from Macquarie. So I'm happy with it. I'm still holding on. I know that there's a couple of things in there that maybe you've got to watch carefully, which is that I think they said there's a bit of a slowdown, right? A bit of a weakish period in this quarterly. Whether that continues or not, we don't know. But the good thing is about it, and this is why the CEO has highlighted it, is that they are so diversified in so many different things that really one thing's not going to affect them that much, right? So if one part of the business is not working, it's not material, so to speak, right? So that's where the beauty about Macquarie. Overall, still going well, very happy with it, cheap.
Well, she's been excellent, that CEO, hasn't she?
Yep. I think it's a continuation from the previous CEO. So well done to them. So far, so good.
No, but one for the girls there. She is.
Yeah,
she's been very, very good.
Definitely.
And okay, it's went down to 130. It's sort of bouncing back a little bit. The daily doesn't look too bad, Wolf.
Well, let me go through the numbers here, right? So let's go through AMD and the update that they've had today. So just give me a sec. So record customer numbers up 52%. What I'm looking, of course, is the revenue numbers up 43% year on year, up 7% quarter on quarter. So it wasn't the best quarter, but it was okay-ish. Cash flow positive with 22 million net cash, right? So all up, not bad. Positive outlook for FY23. So in a space that's M&A, that is the business model, right? They've got software and so on that can help with M&A. The companies that are bidding for companies and the ones that are defending themselves. So for me, okay, the problem is a lightly traded stock. That's one problem. And second problem, is it my favorite story? As a better, more exciting stock? Absolutely. So, it's okay to trade, but you've got to be wary of it because it's just lightly traded and it's not easy to get in and get out.
Let's move on to Cogstate. Yeah.
Yep.
It's an interesting story, this one. I think this one that we spoke with Claude about as well. It's one that he's sort of got his eye on. They do the testing for a lot of these Alzheimer's products, right? So not the testing. They do a lot of the back end work, don't they?
Yeah, the clinical trial revenue, absolutely. Provide the means for other companies to do the testing, right? So not bad. I mean, look at the numbers today. I mean, you've got to like it. I mean, you've got to have a look at the numbers saying clinical trial sales contracts of 82.5 million, up 74% compared to PCP, which is the previous corresponding periods. You've got revenue, fourth quarter revenue of 12.6 million, which is a record quarter for Cogstate, right? Up 26%. Fantastic. FY22 revenues of 45 million, which is up 38%. Beautiful. So all up, you're really looking, you think to yourself, they've done quite well. So I'm going to go to the summary of it, right? And I'm looking at the numbers overall. And I've got, and here they're talking about profitability. So this is guidance with respect to FY22 earnings. For the year to June 2022, Cogstate expects to record a profit before tax, so PBT, of 10.3 to 10.8 million. Dave, that's pretty good. I mean, for a for a healthcare stock, for a biotech maybe, or for a company that's in that space, you don't see that many of them around. So you've got to be liking that overall. It is going to be a lumpy business, no doubt about it, right? It's not the perfect model, right, because of the nature of the two businesses that they've got, but there is definitely growth there. You can see that there's more and more interest in that Alzheimer's and other I suppose diseases in that space that are being tested by other companies out there, which obviously use the products from Cogstate. So looking good. I don't mind this at all. I think this is the one that's possibly on the up over the next
And unfortunately, we haven't really come yet across an Alzheimer's drug that works.
No, that's right.
So there's a lot to go there, and obviously we can see that, because if there was one that would work, they'd be giving it to Biden.
You can't help yourself, can you?
No, of course I can't. Long live Trump. CIA, Wolf. Why don't we compare FMG and CIA together? Yeah.
Okay.
Because tell us.
It tells us a lot, doesn't it? It tells us a lot, the differences between the two companies. I mean, it's sometimes difficult to compare because two different jurisdictions, two types of different ores as well. But let's look at the margins. I mean, that's probably the best way to look at these, right? So let's look at CIA first, because I've got that up on my screen. And it makes, again, fascinating reading, because what a difference 12 months makes, right? Even less than that, where you had huge prices for iron ore, then it obviously comes down, which is obviously nothing, there's nothing they can do about this. But the costs also went up, which means the margins shrank significantly for CIA. So if I'm looking at the numbers, and I'm just going to go down to the figures here.
Well, I think they're all in sustaining costs of CIA.
Yep.
Is $93, and that's gone up from 72.
Yeah, exactly. So that's up 9%, right?
That's 29%.
That's massive, right?
Yeah.
And then you look at also, Dave, have a look at the statistics on the realized pricing, or the net average realized selling price, from 276 to 138. Right, you can see there's going to be a massive impact, right, on its cash flows and profitability. I mean, there's no doubt, and we've seen that. We've seen the revenues go down from 145 million to 279 million.
Yeah, they get a higher price than FMG, though. I mean, it's a quality iron ore, it's a quality product. But yeah, when you look at FMG, what's their all-in sustaining cost? 25 bucks?
They actually don't say that, right? But I reckon it's around the 30 mark.
Maybe so. Okay.
Yeah, maybe even slightly higher, maybe getting closer to the 40 buck mark. But they don't actually say that, and I'm sure it's probably somewhere, which I probably have seen them, but I expect escapes my mind. But the C1 cost they're talking about is still around what, 17 bucks. So they're not going to be as high as CIA. It is definitely not the best iron ore either. Irio and BHP have got that cornered, but it's still probably better margins than I'd say CIA would be getting at the moment. And
I think what helps FMG is the fact they own their rail, don't they?
The infrastructure, absolutely.
So they can control it.
100%.
He loves his little choo-choo trains, doesn't he, Andrew Forrest?
He does.
Choo-choo.
And I think also maybe, is it easier to control your costs if you're in Australia than somewhere overseas? I don't know.
Yeah, well, I think it is.
A question to pose as well. It's probably true, where if you've got everything in the one spot, it's probably easier. Anyway, yeah, CIA, you'd say at the moment, where's it going? It's probably going down.
Yeah, and I think really at the moment, both of them at the moment, from a technical point of view, look a little bit struggling, Wolf.
Yeah, I agree.
And the danger is if iron ore does come off a lot harder, these are going to go a lot lower.
Yeah, especially the ones with the lower margins, right? They're going to go absolutely much harder down. So that's why I'm a little bit worried about CIA. I think the margins are much lower than it is for FMG at the moment.
So really, if you look at CIA, I mean, possibly if iron ore holds where it is, it might hold that 427.
Mm-hmm.
But if it got below 427, Wolf, you'd get out from a technical point. Well, you should be out now anyway, technically, right?
Yes.
But if you weren't out, if it got below that 427, you'd have to get out.
Yep.
Art, Wolf, up 15%.
Yep.
Now you've loved this story all the way down here. I think, when did you stop?
I fell out of love with it. I mean, we talked about it many times now that I just don't like its business model where, where you've got a task that's been given through Airtasker, somebody accepts it, right? So you go and the trader goes out, that does the job, but the trader goes to that person that they've done the job for and say, don't go through Airtasker because I have to pay fees. Just go through me directly, and they bypass Airtasker altogether. That's the problem with Airtasker right there, right? So that's why I fell out of love with it. And for me, possibly you'd be looking at something else. But saying that, right, if you look at the business, it is growing. Operational update was pretty positive. That's why there's probably a little bit of a bounce. But all in all, I think there might be a bounce, but it's not my cup of tea at this stage.
Right, so avoid that one. AIM. So we've had some good moves on these hot stocks recently. Now AIM hasn't had a move yet for us, Wolf.
Yeah,
and it's just holding around trend on the day. I think we said stop loss at 29 on the. It's still okay, right?
Yes.
So
I have to say, I was a little bit disappointed when I saw the announcement this morning. They could not hit their bloody guidance. I mean, that's the first thing I look at. Have you hit your guidance, right? That's probably what the market's probably looking at this.
Well,
as
they missed it by 200 grand.
It doesn't matter. Probably they missed it by $1. They missed it.
I know. It's
like the market is at the moment.
I think they said they'd be between 60 million and 62, and they came in at 59,800.
Yeah, exactly.
I mean, come on. But it's a little bit like it's trading 1 times revenue, and they you think the market would say, okay, you missed your guidance, but you're trading 1 times revenue and you're still growing, and you're making profits.
But the market's really be too tough at the moment, right? Where the problem is management, if they cannot hit their stated goals, you've got to question the management, right? You've got to question the management and say, if you can't hit a number that you're going to say that you're going to hit, we don't have much confidence in you that you're going to hit any numbers in the future. And I know how hard that sounds, but unfortunately, that's how the market sees these things.
Yeah, but I think, you know what? I get it because they look and they say, but there's certain, I like a CEO that pushes his team as hard as he can.
But because be like a Macquarie, right? Say you're going to get 55 to 58 and come up with 59.8.
Well,
the market will probably drive this to 60 cents by now, Dave.
Yeah.
How is that, right?
Listen, I still think at the moment it's a hold. It's trading. You still got to pay 34.5. I'd still be holding it. See,
it's absolutely frustrating. I mean, I could see this one going to 60 cents, 70 cents even, right? Because it's so cheap. And all they had to do is hit the market or come up with a little bit more, give in the bloody guidance, and they probably would have done it. And it could now struggle for the next month or so because of that.
All right.
Anyway,
but Wolf, we got a few stocks which are trading 1 times revenue.
Yeah.
And for those people who don't know that, that's basically what we're saying is that their market capitalization is the same as their revenue.
Yeah.
And you often hear Wolf talking, if it's 5 times revenue or under 10, it's cheap.
Yeah.
So when you've got 1 times revenue, you scratch your head and think that looks really cheap.
But it has to be in the tech space, right? I mean, tech space is there that we do these guides on, right? So look, absolutely. 1 times revenue, it's like giving it away for free.
Right. So let's go to TNT, which is another stock. It's 1 times revenue.
Yeah.
So they're flat today, and the market's still not buying the story. It's still below trend. I'll have a look at the daily. The daily just doesn't want to go yet. So why doesn't the market believe in this story yet, Wolf?
It's a very, very good question, Dave.
Well, that's why we pay you the big bucks to tell us the answer.
The answer for me, I don't want to run away from the answer, but the answer for me, I think the market's still waiting for the full year results, maybe where there's going to be a breakdown of all the companies they've bought over the last 2 years to see how they're all going. Because at the end of the day, they bought a lot of companies to add, to bulk themselves up. give them scale. But I wonder how many misses they made in those buys. I mean, there could be one business that's driving all this growth for them, right? We don't even know. So I wish I could see that, to see where the mistakes were made, where they've made the good moves, and so on, just to give me a bit more clarity and maybe a bit more reason to love this story, where I've got my more transparency, right, in this instance. But still, at the end of the day, without seeing those numbers, if you look at just what they've presented us today, it's pretty good, right? You've got growth, and whether you're going to believe the numbers or not, you have to, because that's what they come up with. There's organic growth and there's acquisitive growth, right? So all in all, there is growth. And when you see trading on 1x revenue, it looks cheap. It's EBITDA positive. So I have to classify this as a tier 2, which means that is definitely tradable, but the market's probably just still waiting on it, maybe another quarter or two.
AAC.
Mm-hmm.
So Australian Agriculture, this is a company that basically murder all the cattle and beef and all around Australia. It's I think Forrest has just put a lot of money into it.
Mm-hmm.
Wolf, what a ridiculous announcement. I mean, we got foot and mouth on the door of Australia, and you'd think they'd be saying, listen, we're doing everything we can.
The plan of action just in case it hits, right?
We're putting gloves on the cattle, and we're doing everything we can so it doesn't come here.
Yeah.
And they just put a little line at the end. Oh, we're just watching it. We're just watching it.
Exactly.
It could wipe out our industry. We're just watching it. What?
I thought they're going to address this. I thought this announcement was we're going to address through the mouth if it comes in. This is what we're going to do. This is the plan of action, plan A, B, C, D, right? Whatever. No, it's like what through the mouth? There's nothing.
Yeah. We'll read it in the paper. We'll keep an eye on it. It's fine.
Anyway, that's my interpretation of what I saw today. I mean, that was just
So you're disappointed with it?
I was just a lack of information of what might give us some sort of an idea what, if it does come in, what it might mean for you guys, all this sort of stuff, right? You'd like to know if you're an investor or you are a potential investor, not reactive. I want to see proactive type information.
So
anyway.
our general feeling is stay away from these stories until foot and mouth is over, or the scare of that it could enter the country is over.
Yep.
Now FCL.
Mm-hmm.
Obviously we got out when it broke the trend up here, and it's looked terrible. It's starting to show a little bit of life, Wolf, right?
Mm-hmm.
Would I buy it? I don't know. Technically, I think it needs to do a bit more for me. But what's your feeling on the fundamentals?
It's improving, Dave. It's improving. It's not going to be profitable for a long time, right, but it is cash flow positive, which means EBITDA positive. That's a tier 2 story for me, right? They've just reiterated their guidance, which is nice. They had a pretty good quarterly, which is nice. So I think
Wolf, can we always talk about EBITDA positive and NPAT positive. So EBITDA positive, just to explain to members of Equity Story, means that if you actually look at the company, you look at the product it's producing and it's selling, and you include the cost to make that product,
correct,
and you include the salaries, right? If it's EBITDA positive, they're making a profit, but they're not making what you could call NPAT, which is making a clean profit at the end of the day, because they've got costs of borrowing money, or they've got interest on depreciation.
Yep. Tax.
So EBITDA positive. So when you tell me a story like FCL and you say, Dave, it's EBITDA positive, and I'm thinking, well, hold on a second. This is largely a lot of software.
Yes.
But they're not going to be NPAT positive for a while. I'm thinking, well, why? I mean, if they're making a product and they're selling it and it's paying for it and they're in a profit there, what part of this business is pulling it down?
It's a good question, right? It depending on the company's, I suppose, accounting the depreciation amortization accounts for a lot of losses on the books, right? So if you've got the EBITDA, which is excluding the D&A, which is depreciation amortization, that's what potentially could throw this into a negative NPAT. And it's part of the modeling of accounting. When you do your long-term cash flows and so on, you've got to include that into your cash flows. Dave, it's an art, I suppose, in it, but that's why I suppose a lot of the businesses look at EBITDA as the first line of profitability, right? Which is their cost of goods sold before everything else goes through it, which is okay for me, like I said, but it doesn't tell you the full picture.
But I know, I'm just interested in what their depreciation is, because
well,
if they're putting like
you've
crazy...
got to go from each company will have probably different things that they depreciate.
Yeah, but I mean, if it's like a ridiculous thing like computers or whatever,
yeah,
well, it does give you that confidence to say, well, if times get hard, well, guess what, guys, we're just going to keep the same computers for a few more years, right? I mean, you've got to understand what I'm saying. These businesses, yes, they're EBITDA positive, but what does that exactly mean for that company? Because it's a different story for everybody.
I think, yeah, absolutely. But I think what we're probably going to find from all these EBITDA positive type stories, right? And generally, the reason why they're not profitable is because they are expanding rapidly, which means probably more. Let's call it in simple terms. When you expand, you get probably more headcounts, more computers. That's where the depreciation it just keeps expanding and expanding and getting bigger and bigger. So it's almost like your revenue is going up, but your depreciation and amortization is going up as well, right? So once you get to a certain, maybe a level or a scale where you don't have to hire as more people, you don't have to get more equipment, as much, spend on or stuff, then you've got that margin we can start working when you just sell the software and then you just pure profits coming through to your bottom line, right? It's the scale. If you want to get to the scale, then you're looking at good. That's why the early companies, it's very difficult for them to become profitable, because without growth, they're not going to get there. They're not going to get the bottom line.
But I definitely prefer like a company like FCL as a company EBITDA profitable than I would an iron ore company, Wolf, that was EBITDA profitable.
Yeah, look, I think, like I said, I think at the end of the day, it's a fine balance between growth and having that profitability or cash flows in this market. And then it comes to scale. Once you get to a certain scale, you can then, probably see that improvement in your margins. And that's why that's why I love the models of the tech stocks, because that scale up where, all you need to do once you get to your saturation of market, I don't know, it takes you 2, 5, 10 years, whatever. All you're doing is just selling the same software over time, where you don't have to spend as much money on developing the products, for example.
Wolf, do you buy this fundamentally or not?
Yes.
Okay.
So
the answer is, if you're going to buy this, you're going to be paying 164.5, and you're going to put a stop loss at 156. You happy with that?
I'm happy with that. I think this is the one that potentially has got that nice improvement in it to $2, right? I'm happy to take that from 160 something to $2. That would be a nice result.
All right. The other one is ELO. So again, this chart doesn't look too bad. All right. So another company had a very good announcement, very strong.
Yep.
Problem with this one is so lightly traded.
Yeah.
And I think you've got to look at that if you're going to obviously, understand that it's going to be hard to get. I think in this stock, it's hard to get $5,000 in and out, isn't it?
It is, but you know what? Maybe just don't go harder. They just have a small little flutter on this, because again, it seems like they've turned the corner for me. So looks like they are talking about getting to that scale for them. Over 100 million in revenues they're going to have in FY23, right? And that's what they're talking about, reaching operating cash flow break even in FY23. Talking about EBITDA, let me see. There's an EBITDA here of underlying EBITDA of 7.1 million, up 6.5 on PCP. So there's those factors that we look at, right, in this market, where you'd see that the investors are going to get interested again. They are delivering. That is a cash flow positivity, scale, hitting the targets, which is important. Again, we've seen that, and some decent growth. So I think this has got, again, one of those hopefully rises from that $2 something to $3 plus.
And again, if you're going to buy this, just a tight stop, just under, maybe get a little bit of leeway under that 260, say 258, somewhere around there. All right, Kogan.
Yes.
Wolf, been in a terrible downturn. This stock gave no indication it was going to pop.
Yes.
It's popped up 38%. So it's gone back to where it was trading in May, which, to be honest, wasn't too long ago. It's only two months ago. So you might look at that and get excited. Certainly that price action is not bad at all. I know it's sticking on the weekly. And, you know, this one could pop up a little bit higher. So still risky because of the nature being retail. Would you have a flutter with Kogan?
No, I wouldn't have a flutter on it. Look, there could be some short covering, which could drive this higher, no doubt, right? So if you are in this, really tight stop loss. Would I be chasing this if I'm not in? No, I wouldn't. And the reason why is the actual update wasn't fantastic. I mean, look at it. Gross sales grew by what, 0.1%?
Yeah, there's no growth.
Gross profit declined by 9.4%. And the positive thing was that they've finally got the EBITDA under control, and it's 19.1 million positive, which is nice. But all in all, I think in a retail that's maybe being hit at the moment by recessionary pressures, I wouldn't be touching this.
Yeah, well said, Wolfie. ALX takeover offer hasn't happened. Bang! It just shows you the danger. If you get these takeover offers, like we said when it did have an offer to take your money.
Yeah, I think you always have to take some money off the table when there's a takeover offer, just in case.
FZO Family Zone, Wolf, has been in a horrible downturn for a while.
Yeah,
a really poor report.
Well, look, there's good and bad in this. The bad is really outweighs it for me because it's so bad, and that is the negative cash flows, right? So if you look at the business, and I know it's had again a little bit of a jump, you name it, right? Because it's growing at its top line. But if you look at the numbers, I'm going to go down to the cash flows. Hang on a second. So you've got 11 million quarter of customer receipts, 11 million, and 12 million outflows, cash flows. So it means that stuff were actually more costly than the receipts from customers. What's that work, Dave? Okay, pass. So they've lost so far year to date 35 million in cash outflows. That is
this another business where we've got to go and get a job with?
No, it sounds like it.
Who are the best payers? FZO or one?
I don't know.
I think there was a company the other day. I think their costs were
almost 80 million or something. Wasn't it?
80 million, yeah.
I can't remember who it was.
I think we both applied, didn't we, the next day?
Yeah, well, I put in multiple applications from different names, aliases.
All right. On that note, we've waffled on long enough, but
it's been a long one, but we had to because there's a lot of announcements today, and we've got a couple of stories to play with.
So the bounce is still happening. Like I said, I'm not buying it. It's temporary. So I think towards the end of August we get the big sell-off. We get the crash.
Yeah.
Crash.
Yeah.
I want to.
Yeah, I'm not crash. I am a bit more.
Wolf is a little gentle. And hopefully we don't get the crash, but I think we get the crash. So I'm not really buying this. I don't buy what the Fed said last night. I think it's all a lot of waffle. Like we said, 2 quarters of negative. We are in recession in America, although the Biden government, for the first time in history, have got a different spin on the version of recession. It's what they call a general slowdown. But you know what? We're having some bounces. We're having some bounces in these little tech stocks. So
let's enjoy them.
Let's enjoy them. And the ideas today is FCL and ELO. If you're going to go there, guys, please, a very, very, very tight stop. And the same with AIM. I know we like it. We think it's cheap, but like I said, if it closes today 28, maybe 28 cents, we'll get out of it and we'll move the money somewhere else.
Okay.
On that note, Wolfie, thank you very much, champion. Have a good day.
Yeah, one more day tomorrow. Cheers.
Okay, bye.